Last week, we've talked about loan losses, the fact that they've set aside billions of dollars in anticipation that, a certain percentage of their clients are going to, default on their credit cards, on their mortgages, on their loans.
Welcome to another episode here at a TF Team, a podcast series. To the left of me is the guy who looks good in any angle. That's what he just said. I don't know what angle he's talking about. Obtuse. Acute. He's not an acute angle. Whatever that is. So I was told earlier this week that I need to take some vacation. I need, because I didn't take any vacation in 2024, I need a mental reset. Do you think that you need mental reset?
I think we all do, right?
We all do.
I think it's always good to decompress and for your mental well-being and just kind of relax.
So maybe a week, maybe 2 weeks, or whatever.
Exactly.
But if you take a long reset, let's say 2 years, and you just decide to close everything and you don't do any buying or anything of that nature.
Good segue.
Something happens that I didn't know happened.
Yeah,
I learned that today. You learn every day.
Yeah, which is a good thing as human beings.
So what are we talking about?
So really, as you know, your credit score is so important. Yeah. It gives you the ability to borrow, to also rent. Also, to find a place to live. So having a good credit score, 680 or above, is important. But one of the things that people probably didn't realize is the fact that let's assume that you decide, you know what? I'm going to live without credit, right? Which is not a bad thing. We always talk about, right, that if you're going to do one thing, reduce your expenses, and a lot of times credit cards are a big part.
Right.
So there was this individual who, wanted to get a good handle on his financial affairs, didn't borrow, didn't use his credit card, paid cash or through debit, right? And there was inactivity on his credit bureau file. So there was no credit card transaction, no loans, no line of credit. And as a result of that, his credit score reset to 0. So there's this unwritten rule that TransUnion and Equifax has. If there's been no activity on your credit report, then it's as if you're a brand new customer and your credit zero starts back at 0.
And to start back at 0 means like you got to do so much to repair your credit.
Exactly.
Right? And I think you told us the last time about the story about repairing your credit. So someone probably stole your identity. And that's why you should check your credit score often.
Exactly.
And all of that nature. But that will just take a lot of work.
Yeah, because you've got that individual had to try to connect with Equifax and TransUnion, both credit reporting agencies in Canada, and that took a while. So that meant he was looking to borrow to buy a car, to get a car loan, and that was on the wayside for months until the bank, until he was able to repair his credit score, and then ultimately be able to get the car loan. So, thing to note is that even if you make one credit card payment or one transaction, one every 2 years, then that will kind of ensure that you're that it's not reset. But having said that, that 24-month or 2-year rule is not steadfast, because I've heard from TransUnion, and they're saying that the inactivity for 18 months will also reset to 0. So you want to keep that in mind.
So don't go away to Florida and forget about your credit card in Canada, because they're going to reset it, right? For 18 months. Unless
you're out in Florida for a whole 2 years or 18 months.
It shouldn't be an issue.
Exactly.
So the reason we're talking about this and resetting your credit score is because we've come across two headlines this week, or last week rather, that talked about credit. The first one, let's talk about Equifax first. That young people, well, not young, consumers, sorry, consumers are missing credit payments.
Yeah, so it's been up for Q1, first quarter, January to March. That it's been up. It says like 1.4 million customers have missed a credit payment in Q1. So that has a very negative impact on your credit score.
Is this an indication that, or is this why the banks have provided so much for loan
Exactly.
losses?
So last week we've talked about loan losses, the fact that they've set aside billions of dollars in anticipation that, a certain percentage of their clients are going to, default on their credit cards, on their mortgages, on their loans. This kind of reinforces the reason that they're doing that. And again, from the bank's perspective, having the loan losses, it's kind of like having an emergency fund because they realize that there's going to be a segment of the population that's going to miss on their credit payment.
And this means that with credit cards, with the debt, the rate being so high, you miss a payment, then you're going to pay unnecessary expenses. Now, I know things can get really tough, but this is why we've been saying in terms of a bottom, like it's been a sore point, but it's like a broken record.
Exactly.
But having an emergency fund, this is where you can tap into that to ensure you don't miss that payment. Because if you miss a payment, you go delinquent, your rating is affected at the financial institutions and your credit score.
Big time.
Your credit score.
Yeah, the biggest impact on your credit score is missed payments, right? So if you pay at least the minimum, required, and sometimes it could be as little as $25 to $50, just make that minimum payment on time will not impact your credit score.
So at least if you tend to forget, you get caught up, you're busy. Always ensure that you set up with your financial institution or with your credit card company that minimum payment. So they take it automatically.
Yeah, take a pre-authorize of the $25 or $50 by the due date or before the due date. And that way, at least you know for sure that you won't miss that payment.
Because if you're missing on your credit cards, it's highly unlikely the banks are going to want to grant you a line of credit, a mortgage, a car loan, things of that nature.
Exactly.
Because those are bigger expenses, right?
So this is also an indication that, all the stuff that we've talked about last time, the fact that we're seeing those negative headwinds appearing. So this is kind of a leading indicator that is kind of telling us that in the future, we're probably going to see a slowdown in the economy because I'm assuming if you missed a credit card payment is because you don't have the income. And the reason you don't have the income, it could be probably you lost your job. And we saw Hudson's Bay individuals lose their job. 2,000 TD employees, mind you, it's worldwide, are also going to lose their jobs. So all that negativity we're starting to see that in the numbers with Equifax and TransUnion.
Why are young people taking on more debt? That's the other headline from TransUnion now. They're saying that young people are taking on more debt, and it's...
So why are you taking on more debt?
Oh, yes, the youngsters.
What are you, Gen Z, Gen X? I don't know.
I am a... What am I? I am...
don't answer that.
I'm not going to say my age. I'm a millennial.
Okay, there you go.
That's a Gen Y.
There you go.
So the Gen Zs, the people after my era, born 1995, 96?
So Gen Z's 97 to 2009.
So those people are taking on more loans, and they're not making payments. Is it because young people are more risky in terms of taking on more prone to taking on more risk? Is it that they're short-sighted in terms of taking on these big expenses and missing out, or are they just getting these credit cards, piling it up, and they don't have a strategy?
Yeah, it could be a bit of all, right? So, I mean, I know I'm not young anymore, but I do know
Clearly.
some acronyms, FOMO and YOLO.
Oh, yeah.
Right? So maybe it's the fear of missing out, right? You know, my friend's got a Tesla, I need a Tesla, or you only live once. So, you know, we'll worry about that when we worry about. But having said that, I do know a lot of young people, right? Gen Z, Gen X, millennial, alpha, beta, whatever we want to call
I don't
them.
think Alfred thinking about any debt right now.
Hopefully not, and definitely not beta, right? Because that's 2025. But we do see a lot of younger people that are dedicated, that do follow, you know, in their parents' teachings, and are being very diligent in terms of debt. So maybe it's a small segment of the Gen X, Gen Z, whatever you want to call it, that are taking on more debt. But probably now's not the time to take on more debt. It's probably the time to conserve and wait until all those negative headwinds subside.
Yeah, and I think maybe also because of all the indications, as we mentioned in past videos, about jobs being affected and so on, that might play a part. Maybe a lot of part-time roles, hoping that they go to full-time, but they never do.
Yeah.
And they've taken on those risks, and they were hoping that the bank of mom and dad could have helped. But maybe mom and dad is also taking on bigger expenses as well.
Yeah,
right?
I mean, it's a confluence of factors. We've got immigration, all international students pouring in to look for opportunities, which is great. But then now the opportunities are not there as a result of all the confluence of factors that are happening in all around the world. I mean that T word, right? Tariffs, right? That are having that negative impact all over the world, and now we're seeing coming home to roost here in Canada. So let's just put on pause and just make sure that whatever debt you have, try not to grow it too much, and just pay your debt and hopefully pay it down.
And this gives me the opportunity to end the video on this note. This is what I'm going to say. When we acquire debt, whether it's these large sums or small, one of the ways I believe that you can protect yourself in case of job loss, well, not job loss, but in case you get injured on the job, in case something happens to you or your loved ones, insurance is an answer to this sometimes, most times.
So let's keep that
keep that secret
for next episode.
Right?
So
You're going to tell us about the story. I remember you telling me a story.
To put you to sleep?
No! You told me a story.
Okay.
And I just remembered it anytime I talk about insurance, because I remember you told me the story about where you were an advisor at a bank. And somebody took on a mortgage, and then because they had insurance.
I remember that.
All right, we'll tell you more about that story.
A little teaser.
A teaser there.
Yeah, definitely.
Thank you for watching. Thank you, of course. And like, subscribe, share, and hopefully we've got our producer back in our next episode. Stephanie, come back. We miss you. We miss you. Have a great one. Take care.
Bye.
Bye for now.
Bye for now.